Welcome to episode 2039 and greetings from Medellin, Colombia. I am headed home soon, but I've been here for a week and just wanted to share a little bit about the trip, about some impressions. We've got a guest today talking about the real estate market and the economy. Erin Sykes will be here, and we're going to do a couple of things before that. So stick around to the end, and please, if you are watching on video, comment below on some of the items that we raise, because we love to hear your comments and also your suggestions for future shows as well. Okay, so, most people consider Medellin, Colombia to be a beautiful city, and I would agree with that. It's covered in greenery, it's got beautiful topography, very nice weather, and because it's got the high elevation, even though it's a tropical environment, there are virtually no bugs. At least I have not been bitten, and those bugs seem to like me, but they don't bother me here if they are around here at all. But what's interesting about this, and I had dinner with a whole bunch of expats last night. My friend Jean and I went and had a big dinner and drinks with a bunch of expats. And it's just so interesting to hear of the people that leave the US. Some of them have kind of this cognitive dissonance where they have an unrealistic picture of their home country. Most of them were from the US. There were some Europeans there last night. And then they have an overly positive impression of the place they move to, where they expatriate. And I just have always found this to be funny. I've noticed this trend for well over a decade, knowing people all around the world. And when you start to ask them detailed questions, though, the cracks appear. And when you start to hang out in these places around the world, I've been to 91 countries, the cracks appear. So let me just tell you about Medellin. So this picture, if you're watching on video, I took this picture just literally 20 minutes ago. I walked over to the coffee shop after having breakfast here at the Click Clack Hotel, which is mostly considered like the nicest hotel here in Medellin. There's this sign, right? This tourist sign that says the name of the city. It says Medellin on it, or Medellin. I'll say it the way they do. Can't get used to that. And I'm sure zillions of Instagram photos have been taken with people hanging around this sign. But the reality is, it's just a dump, okay? You look at the big picture here and you see all the telephone wires up in the air, the trash on the ground. Here's a picture of the homeless guy who just stinks to high heaven, brushing his teeth by the sign. Like, I took this picture 20 minutes ago, okay? It's just sort of interesting how fooled we can be, myself included. I've been fooled by this too, by looking at social media, looking at ads for places. It's just never as it seems. That's the thing I first want to say. But the other thing I want to say is that I grouse and complain all the time. You've heard me do it for 18 years on this show about bureaucracy in America, about big government, constantly complaining about how government doesn't get out of the way, right? This is my libertarian bent coming out. And you've heard me talk about this. But the most important question in life is always, compared to what? Compared to what? And having been to 91 countries around the world and having spent a lot of time in a lot of these countries, many times over, right? I've been back to many of them several times. It is just so hard to get things done. That's the thing you find out. Americans particularly have a really, comparatively, a laissez-faire environment where mostly the government does stay out of the way and you can just get stuff done. And it's not just the government, although that influences this sort of cycle of thought, but the people in general, the thought process. And I've noticed this definitely in Europe, right? Having been born in Europe, spent a lot of time there. I go at least once a year usually. It's kind of like they view the government as sort of their partner, right? Where the government is here to help them. And they're very interested in following procedures and being very rule-based. When in the US, people just kind of don't put up with a lot of shit. I mean, they do, but compared to what? They sort of don't. They're not willing to like wait in line. They're not willing to have bad customer service. And of course, this is all relative. I know that. So some of you will comment below and you'll say, are you kidding, Jason? Customer service is terrible in the US. Well, I agree with you. Compared to the old days, it was better, right? But compared to other countries, I don't know. I was trying to do some business here the other day. I met with several business people, some bankers, brokerage people, real estate people, and I just found the obstacles thrown in my path everywhere you look, right? And when you look at the US and compare it, they are so receptive to doing business with their own people, their own citizens, but people around the world. It's just really easy to move money into the United States. When we talk about all of this instability in the world, and people are looking at China and the BRICS nations, and, will the dollar lose its status as the reserve currency? I got to tell you, folks, I think the dollar and the US hegemony has a long, long life ahead of it. It's just not rational to think otherwise. Yes, there's nibbling around the edges, no question about it. But think of the BRICS countries, right? You've got a bunch of basically dying countries getting together to talk about trading outside of the dollar and displacing the US, right? I guess my point in saying all of this is really this. The US has been considered pretty much forever to be the Brinks truck of the world. And when I say forever, I mean modern era, okay? Any of our lifetimes, right? The place where capital is safe. And it's very receptive to FDI, foreign direct investment. And that's a big deal for the real estate market and the economy. Because as we see more and more instability around the world, that capital looks for the safest place. It looks for the place it's treated best. It looks for the place with the best rule of law. And I will be the first to tell you it is far from perfect. I know there are many problems. You don't have to start trolling me and telling me, Jason, are you out of your mind? What are you talking about, right? I'm just saying comparatively. Okay, comparatively, the US has a hell of a lot going for it. And this bodes well for the future of real estate and the future of the US economy. So let's take a look at this, right? This is something that I predicted many, 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 many years ago. And it is about the labor pool in China that is now dissipating. For many years, we have been the beneficiary of low inflation by importing cheap products from China and other inexpensive labor market countries, right? So it could be China, Sri Lanka, India, whatever, right? All of these places that we import from. So we've had the benefit of really cheap products that have pushed our inflation rates down. And that's been really wonderful for US consumers. And I have talked about how my theory, and no one says this but me, right, is that Nixon, when he took us off the gold standard in 1971 on that fateful day in August 15th, he thought China is the next big labor market. And he opened up China. And later that decade, China opened up in terms of their own political environment, right? And a lot of it was emanating from that historic trip to China that Nixon took, okay? And so we've been the beneficiary of importing cheap products, which have pushed our inflation rates down artificially, right? And then sadly, our politicians refuse to control our southern border. So they've been importing cheap labor from Mexico to tamp down inflation in the US and keep wages down. Because if you've got, much less expensive labor that'll do the job that has come in illegally, they're going to displace higher priced American workers. So these are two of the ways they have artificially hidden inflation from us for decades now. But that is coming to an end. And the next big labor market that the powers that be are trying to exploit is Africa, because that's a very cheap labor market. But the problem is Africa is nothing like China, okay? In terms of the organization, the manufacturing, the tribal violence and resentment, and the lack of lingua franca language problems and education and just so many things, right? It's just completely different, much less organized than one single country that operates under communism. Say what you will about communism, but it does have a few benefits, as much as I don't like it. It does make things move in lockstep, get organized, and fall in line. So this is going away, and the world is changing, and this is going to lead to much, much higher inflation. And of course, as real estate investors, we benefit from inflation, not because of the simple thing that most people think, right? Oh, real estate's a hedge against inflation because the price of the property goes up with inflation, yada, yada. That's the elementary school version. What we really benefit from is inflation-induced debt destruction, my trademark strategy that I've been talking about for 18 years now, inflation-induced debt destruction. If you're new to the show and you're not familiar with that, go to jasonhartman.com, type in that phrase, inflation-induced debt destruction, listen to my old episodes about it, and you will be amazed, because it's the hidden wealth creator. And here we look at the U.S. consumer. And let's take a look at what they've got going. We know that the housing burden on the US consumer, if they bought or refinanced in the COVID era, the housing burden is extremely low. They've got a very affordable house, a very affordable house payment. 25% of the country mortgage at or below 3%, 65% of the country mortgage at or below 4%, very low payments. In fact, their mortgage payments, and 40% of them no mortgage at all, the people that do have mortgage payments, the 60% that do have mortgage payments, their mortgage payments are essentially what they were 10 to 12 years ago. It's like they went back in time and got mortgage payments on a much higher priced house, but at a much lower interest rate, and they've got 28 years left on these mortgages. Very hard to have any distress there. But the question we have to ask ourselves is, what are the other areas that might squeeze them, right? They're not getting squeezed by their house. The house is a good deal for them, but we are seeing some stress from other angles. Right? And this article talks about U.S. consumer credit card loans and other revolving plans as a share of GDP, of the gross domestic product. And I like this because it's good. It is answering the question, compared to what? Now, there are other things you could compare this to. You could inflation adjust it for real inflation rather than just CPI inflation, which is understated, but at least they're comparing it to the GDP, right? So the gross domestic product. So we see that consumer debt has been increasing. The burden has been increasing, but when you look at it compared to what over the last 13 years, it's not that bad, okay? It is worse than it was a couple of years ago when people were getting stimmy checks and they were locked in at home and not spending any money. But comparatively, over the last 12 years or 13 years, it's actually lower. Okay, so compared to what is the important question to answer. But we do see some signs of possible stress there. Now let's talk about homeownership rate for a moment. There has been just an unbelievable amount of talk about millennials as the violin plays in the background, and everybody feels bad for millennials, and they're thinking, this is the largest demographic cohort in American history. They are a big deal. We've got to talk about them. But is it really what we think? And I mentioned this on the last show, but here's some deeper analysis of this. And if you're watching on video, you see this chart that talks about the homeownership rate for the ages of 25 to 34 years old. So this is sort of the prime household formation years. What is the homeownership rate for these people back to 1990? Okay, 1990 to today, what does it look like for them? Are the millennials really getting such a raw deal that they can't afford to buy a house? Well, it's not as it seems. So if we take the millennial generation, they were born between 1981 and 1996. And in 2016, that is where we had the lowest homeownership rate for ages 25 to 34. I know I'm throwing a lot of numbers at you. So again, millennials born 1981 to 1996. In 2016, the age cohort of the 25 to 34-year-olds had the lowest homeownership rate. And you heard a lot of these complaints. We can't afford to buy a house. The baby boomers sucked all the money out of the economy. Terrible for us, right? Yada, yada. Okay, so the oldest millennial at 2016, at the lowest homeownership point, the oldest millennial was 35 years old. The youngest was 20 years old. So at 20, you shouldn't be expecting to buy a house, although I did buy my first rental property when I was 20, but I still lived at home, okay? I still lived with mom, but I did own a rental property at age 20. So that's where they were, and their homeownership rate was low. But remember, the millennials are on the slow life plan. They are doing pretty much everything in life 6 years later than their baby boomer parents did. So when you lag things for 6 years, you find that the millennials are actually doing very well. I know that may come as a surprise to some. If you're watching on video, comment below and tell me what you think. I can't wait to hear all the complaints because I know they're coming. Okay, so let's compare it to my generation. I am a Gen Xer, and my generation was born between 1965 and 1990. And in 2005, we reported the highest homeownership rate. Now, that was during the Bush era, the ownership society. We saw the homeownership rate rise into 69% of the population owned a home. It was absurd. You know, if you've been listening to me for any length of time, I think that homeownership rate is too high. Yeah, I know. I'm the only one in real estate that says the homeownership rate shouldn't be so high. Why? Because the homeownership rate, actually, when it's that high, it causes a lot of problems for the homeowners because they are stuck in one place. They can't move easily. They can't go to where the jobs are. And when they are young, they should be able to move to where the opportunities are. And I know we got remote work and lots of options nowadays, and that's all great. But still, people do move to where the jobs are, and they want to try different places. They want to live in different cities, different towns, different suburbs. So high homeownership rates actually lead to higher unemployment rates or underemployment rates. So I think the homeownership rate should naturally be around 55%. It's higher than that now. I don't think that's good for society. Now, I do think everybody should own a rental property or 2 or 3 or 5 or 20, okay? And that's what we help people do. You should be in the real estate game, but it doesn't mean that you have to own the home in which you live. You'll benefit with the rental properties. They'll be a much better wealth creator for you than your own personal residence. So homeownership rate, no bueno. Rental property rate, people owning rental properties, that's a good thing. All right, so we've got the Gen Xers, my generation. In 2005, when we had those super high homeownership rates, the oldest Gen Xer was 40 years old, and the youngest Gen Xer was 25 years old. But guess what? The Gen Xers didn't have that 6-year lag like the millennials do. So when you lag everything 6 years, again, it paints a completely different picture. And look, the millennials are going to live longer than their baby boomer parents, hopefully, as long as we get the obesity epidemic solved and the diabetes epidemic and people stop taking all these pharma drugs with all these side effects. That's a whole nother subject. But it's strange. We have this economy that is such a dichotomy, right? And not just economy, but the socioeconomic environment where we've got a digital divide, some people who are good at technology, others that are being left behind. We've got some people doing well, making money, investing, becoming very prosperous, and we've got many others that are left behind, unfortunately. And we've also got this divide in the world of health, and that will lead to longevity, health span and lifespan. So be on the right side of all of these things. All you can really do is take care of your own life and, get financially healthy, take care of the money thing, like I've always said, take care of your health, and just be on the right side of all these trends in society. Okay, you've all heard about the absolutely tragic, horrific, awful wildfires that happened in Maui. And, I've been to Maui a few times. It's a beautiful place, obviously. The conspiracy theories are flying like crazy. And I got to tell you, I entertain some of them, and I think some of them are absolutely true. A conspiracy is nothing more than two or more people planning something, or not even planning something, but being complicit in something. So whether that be, whatever, I'm not even going to say the words because I'll be censored, but they are flying all around the Maui wildfires, and I would really encourage you to seek these things out and hear what they have to say. It's worth listening to. There are many unanswered questions that are very unusual. But one of the things, when these tragic events happen, whether they be natural disasters, man-made disasters, or whatever, counterintuitively, they actually cause real estate prices to go up many times. They cause commodity prices to go up because there's a lot of commodities used in the reconstruction efforts. And so many of these vultures kind of think they're going to go into these areas and buy super cheap properties. If they're developers, they do have some opportunity to buy land. But once the market adjusts, which usually happens pretty quickly in these places, these land prices kind of skyrocket. Okay, yes, there will be a few outlier people who got right in, and usually they'll get themselves some good deals. These are usually much bigger players with lots of cash, ready cash, that trounce on these opportunities. This is an absolutely tragic event. It seems like our president didn't even give a damn. He's sending billions of dollars offshore to fight foreign wars. But again, when it comes to our own people, he doesn't even visit. He doesn't even comment. It's truly pathetic, but it is what it is. Anyway, best wishes for the people in Maui. And just to look around the world before we get to our guest with some of this geopolitical stuff, the media is not covering the absolutely horrific things that are happening in Sweden and around Europe and other countries as well. And I highly recommend that you follow Peter Emanuelson, or Peter Sweden as he goes by, on Twitter, and subscribe to his newsletter. You will just be awakened to some of the things that are going on. Over 100 bombings in Sweden this year. Did you know that? I bet you didn't. I mean, most people don't, because the mainstream media is just not covering these things. And look at this, Afghanistan, 2 years, right? It's been 2 years since this absolutely disastrous retreat where we left all of our expensive high-tech equipment behind. And look at what has happened for human rights, especially to women. This is awful. It's absolutely awful. Okay. After returning to Kabul on this day in 2021, the Taliban pledged it would be more moderate and inclusive than during the previous rule from 1996 to 2001. But since 2001, they have barred nearly 1 million girls from secondary school, making it so they cannot get an education. They have prohibited women from going to universities. They have banned women from parks and gyms, and they have ordered aid groups to, quote, suspend work of all female employees. This is absolutely tragic. I mean, if you are into human rights, women's rights, whatever, it is just unbelievable what these primitives are doing. And it's so sad that we basically let this happen after spending all of that money to fight this war, which was probably, that's another discussion whether we should have ever done it or not. But the fact is we did do it, right? We should have, at least once we're in, made our investment work for the good of humanity. But, this is where we are, right? Anyway, enough about geopolitical stuff. Let's get to our guest today, talk about real estate, talk about the economy for a few minutes with Erin Sykes. Here we go. It is my pleasure to welcome Erin Sykes to the show. She is a real estate wealth advisor and the chief economist at Nest Seekers International, dealing primarily with high-end markets in different parts of the country. And I think she's going to offer us some good insights as to what is going on in those markets, because that is one end of the real estate marketplace that we don't talk enough about on the show. So I can't wait to learn more. Erin, welcome. How are you?
Good. Thanks for having me.
It's my pleasure. So, a lot of turmoil going on in the economy, obviously. Interest rates, I'm surprised at the Fed's last move. I mean, I really am surprised. I thought they would make a U turn, but they haven't done it yet. It's sort of hard to figure out where the economy is. I mean, we're not formally in a recession. Unemployment rate is extremely low, but sales volume is down in real estate for sure. Prices, it depends where you ask, what segment of the market. What are wealthy clients saying and doing right now?
Yeah, so I think we've got two main camps in general throughout the United States. Those who have their heads in the sand and say, everything's fine. Everything's great. No changes here. Let's keep the prices as they were. Real estate's going to be fine. Our bank account's going to be fine. They ignore the inflation information. And then you have a camp that's actually quite scared. And, there's not a lot of stability in between, which is what's concerning to me. Because when people are making real estate investments, as advisors, we, for the most part, advise that these are long-term investments. And what we saw over the last 2 years of being able to flip and double your money in a month or 6 months, that's not logical. So I think we're resetting a lot of mentality, and that's in both of the high-end market and then also in the lower-end starter markets. So what is very different about the high-end market is that within the last couple of years, you saw a lot of high net worth individuals pulling their money out of equities because they saw what was happening with inflation or what was going to happen with inflation, and the stock market likely follows. However, they moved it into hard assets, so real estate, jewelry, art, etc. So that was their form of hedging. And that's why the top tier, that top half of 1% of the market has continued to be strong. Of course, they tend to be cash transactions. So they're not as concerned about interest rates, but they are concerned about the general economy. And that's why they did move their money into real estate.
Every decision when it comes to money is always a decision of the least worst choice, right? It's always that old acronym in the investing world, TINA, T-I-N-A. There is no alternative. So are people thinking that real estate is the safe harbor? I've noticed it's interesting too that you even mentioned jewelry, because I was going to sell one of my watches and I stuck it on the most popular watch website, and it went from a peak of like $78,000. And last time I had it listed, it was $49,000.